On Wall Street, we've all been conditioned to believe that good news is bad news and vice versa. Maybe if the economy is too strong, we can expect the Federal Reserve will raise interest rates, bad for growth, and if the economy is weak enough, the Fed will cut rates. Good for growth and the stock market. But sometimes bad news really is bad news, like the very weak employment numbers we saw this very morning, something that shows the economy is producing far fewer jobs than expected. Like many others, I was rooting for a weak labor report in hopes of lower rates, which usually means higher stock prices. Unfortunately, we got something so weak, I didn't want that it feels like even lower rates won't resuscitate things, which is why the Dow went up initially. But then when people looked at the numbers, they realized they weren't so good, and it lost 220 points. S&P shed 0.32%, and the Nasdaq declined 0.03%. And that's what happened today when we discovered that this gigantic economy is simply not creating jobs in any meaningful quantity. And the Fed may not be able to stem the tide with just a quarter-point cut, which is what's expected. If that's true, then corporate earnings may be coming down, and credit, which has been robust, might get tighter, leading to rising defaults, hence why the banks led the entire market lower today. Sell, sell, sell. Now, before I talk about what's coming next week, let me put in a little ray of sunshine in the equation. I still think bad news is only going to be good news because unemployment isn't really spiking. We have lackadaisical job growth, and rate cuts will stimulate the weakest part of business, which is housing. I always say that housing punches above its weight in the economy. Because when you build a house, a lot of things happen beyond hammers, nails, and wood.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.